The last year has been rough for a number of companies, especially companies that don't have solid balance sheets and cash flows. And there's one company that's down 79% over the past year that I think could go even lower. That is Plug Power. Now, this is a stock that I have been critical of for a very long time, but it's finally coming to fruition that this company doesn't seem to be sustainable in any way. So I'm going to get into some of the details and why this is a stock that I would avoid, despite the fact that it is in some massive growth markets like hydrogen and clean hydrogen in particular. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they're going to give you their top 10 stocks to buy right now. I want to start this video with what Plug Power actually does and where it generates revenue. Now, there are a few ways that Plug Power breaks out their results on their income statement: sales of equipment, related infrastructure, and other. So this is basically hardware. In the most recent quarter, that actually dropped a little bit to $145.1 million. Services performed on fuel cells, $9.3 million. So pretty small business, but a lot of companies are selling services for hardware that they sell. Power purchase agreements, this would be companies that are actually buying electricity from assets that Plug Power has put in the ground. $20 million in revenue there and $19.4 million in fuel delivered to customers. Now, if you look at the financials for each of these, they break down the cost or the gross cost associated with each of these businesses, and you see that they're losing money everywhere. Equipment costs $159 million, so far exceeding the $145 million in revenue. Same thing for services. There's this loss for contract-related services, $56 million on power purchase agreements. So basically every power purchase agreement for every dollar of revenue, there have $2 in losses. And then fuel delivered to customers, same thing. $19.4 million in revenue, $59 million in delivery costs. You can go back into previous quarters and the number will fluctuate, but the story is the same. The company is losing money on every dollar of sales that it has. This is on top of operating expenses, SG&A, over $100 million in a quarter, research expense. You obviously need to do research if you're going to be producing fuel cells and advancing those kind of products. So losing money there. But if we look at what they're actually selling, I think this is really telling as well. This is Plug Power's GenDrive product. This is really what drove a lot of the company's growth over the last decade. And this is a fuel cell retrofit system for forklifts. So this is not a company that's generating most of its revenue on electrolyzers or on hydrogen-powered vehicles. They're doing material handling, powering forklifts in Amazon and Walmart warehouses. That is the biggest piece of their business today and continues to be that. They have a number of different products, but this is the biggest seller right now. So they break this into ProGen fuel cell engines and then GenDrive, which is the retrofit right here. You can see this. There's basically just components taken out of a typical Raymond forklift, and this is where a battery would traditionally go, and you just replace that with a hydrogen fuel cell. Now, there are other areas that the company is growing in: electrolyzers, backup power. These are the things that the company wants investors to focus on, but the reality is that most of the business for the last decade has been retrofitting forklifts. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Now, this could be a really good business, but remember, Plug Power is not a new company. This is not a startup that is in some sort of unproven markets or unproven technology. This company is more than 20 years old. It's been on public markets for a very long time. And what we have seen is that it's never been able to report a profit. This chart, I think, is extremely telling. As Plug Power has grown over the last decade, losses have gotten worse. This is not a company that benefits from scale. Margins aren't improving. It's not leveraging operating costs. There has been simply no benefit from growing as a company except for cash is getting worse. If we turn to the balance sheet, we've now gone from a company that has been funding itself through stock sales to at least in part funding itself through debt. And I think that's where this becomes really challenging for investors. There's really no way out if you can't have a financially sound business that's generating cash to be able to eventually pay down debt. And now there's nearly $500 million worth of debt. You can see here the cash and short-term investments that the company got during the pandemic. You might remember some huge investments it got. A lot of that money has been burned off. You can see that there's less than $600 million in cash on the balance sheet. And remember, cash burn is extremely high. You can see that free cash flow has just cratered, just at an absolutely unsustainable level. And at this rate, the company's going to run out of cash within the next few quarters. And this is one of the reasons that the stock is down. Now, this is not a new problem for Plug Power. The company has been burning cash for decades. But what has the company done? Well, it's been able to go through these hype cycles and raise a tremendous amount of money when the stock goes up in value. Now the stock is falling. You have that debt on the balance sheet. And I don't think there's the same hype behind a company that has proven that it's not going to make money at scale. This is a look at Plug Power's shares outstanding over the last decade. You can see that we've gone from 76 million shares outstanding to 591.1 million shares outstanding. Just incredible dilution. And if we went back even further than that, this is something that has been happening for a very long time at Plug Power. They just continue to sell shares and sell shares, but they need to have that growth story to keep the story intact and keep the stock price high enough where they can continue diluting shareholders. Now, I know there's a lot of hype behind some of these new developments like electrolyzers, like hydrogen as a backup energy source. And I think there's a lot of potential for those markets long term. In a decade or two, I wouldn't be surprised if hydrogen, and particularly green hydrogen, is much more common than it is today. But this is an industry that's going to take a very long time to adopt those kind of technologies. So businesses need to be able to generate cash to survive in the meantime if they're going to exploit those hundreds of billions of dollars worth of opportunity long term. And Plug Power has not shown the ability to have a sustainable business in the meantime while investing in some of those long-term investments. Frankly, the hydrogen industry in general has been at an unsustainable level for a very long time. But Plug Power, I think, is one of the worst offenders of this. They are phenomenal at releasing grandiose press releases and having huge growth targets, but they never actually live up to them. I've been covering this company for over a decade now. And even back then, even 10 years ago, they were talking about being EBITDA break even or proxy for cash flow, saying, hey, we're almost there to break even. And you can see from those numbers earlier that they were nowhere near break even. In fact, their losses and their cash burn have gotten worse and worse over time. I think in the next year, we could get to that breaking point where the market says enough is enough with the dilution, enough with the cash burn. We're not going to provide more money to this company. If the stock keeps falling, that's exactly what's going to happen. So the stock may be down a lot in the last year, but I think it could fall a lot further. And I wouldn't be surprised if Plug Power does not survive in its current form long term. It probably needs to go through some sort of restructuring and really get its cost structure and its markets right so this can be a profitable and thriving business long term. Like I said, a lot of potential here in the hydrogen market, but Plug Power, absolutely not the way to play it. Do you disagree? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.